Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. Today marks the day that I'm a year through my investing journey, so I thought it would be a good opportunity to take a really detailed look at my portfolio, how it's developed over the year and some of the things that have impacted its value. We're going to take a detailed look at my account, my investments, some of the fees that I've paid and the dividends that I've gained throughout the first year. I'm then going to set myself some targets moving forward for my next year of investing for both my Vanguard account and my new trading 2-on-2 portfolio. That's all I've got to say really. Let's hop into my portfolio and have a look how it sits after 1 year. So here we are inside my Vanguard account. You can see that a year after starting my Vanguard ISA, the current value of the ISA is £2,809.62, and that equates to a personal rate of return of negative 0.03%. Now, bearing in mind all the things that have happened this year, what with the coronavirus and Brexit, I'm fairly happy with how my portfolio has performed, with it being up to as high as 16% positive, but also down to negative 27% at some points. So to finish off the year, my first year investing, kind of breaking even as to where to the amount of money that I've put in, I'm fairly happy with that, and I'll take that moving forwards. If we have a look at the performance of my portfolio in a bit more detail, we can see that the negative 0.03% equates to a 38 pence loss throughout the year. While it would have been nice to see a positive rate of return in my first year of investment, as I've already said, I'm not too disappointed with this slight loss throughout my first year. We can also have a look at the individual performance of all the funds that I'm invested in. Here you can see that the majority of my losses have come from the FTSE 100, which has been hit particularly hard this year. My best performing fund is the FTSE Developed Asia Pacific ex-Japan ETF. However, I did only start investing in this fund after the downturn, and therefore the 10% in growth you can see is that bounce back that we saw. It's the same story for the FTSE Emerging Markets. Again, I invested in this fund after the dip, and you can see that since that, I've had quite a nice rate of return of just under 5%. The fund that I'm probably most pleased with this year is the S&P 500, which is well renowned for its continual growth year on year. Despite the coronavirus and everything else that's been happening, I've seen just under an 8% rate of return this year, which is really pleasing. In addition to that, the fund's paid me £6.70 in dividends as well, which I've reinvested back into the S&P 500. And finally, moving on to the Lifestrategy, this is the fund that I've been invested in the longest. This was the first fund that I invested in when opening my Vanguard portfolio, due to the level of diversification and the passive nature of the investment. Again, you can see I've made a small loss here. However, all things considered, I'm still fairly happy with the performance throughout the year. As it's the 100% equity fund, the fund is more susceptible to market variation, and therefore if I'd invested in an 80%, a 60%, 40% or 20% equity fund, I'd probably be in a positive rate of return for my Lifestrategy investment. Vanguard is well renowned for the cheapness of its fees, and that's really clear when looking at my investment calculations throughout the year. Bearing in mind I've invested £2,810 throughout the year, I've only paid £2.17 in fees. On top of that, I've gained £19.42 in dividends, so the dividends alone more than pay for the charges from Vanguard. When you're investing, it's really important to keep your fees as low as possible, because this can really inhibit the overall growth of your portfolio. Like I've already said, this is one of the reasons that I chose Vanguard when starting out. Since then, I've seen that on trading 2-on-2, you can actually invest in Vanguard ETFs without having to pay an account fee. You only have to continue to pay the ongoing charge fee of the fund. So in the future, I might consider moving my Vanguard ETF portfolio across to trading 2-on-2 with my individual stocks and shares account. Unfortunately, trading 2-on-2 doesn't offer the Vanguard Lifestrategy products, and therefore I'd have to keep my Lifestrategy investment on the Vanguard platform. This is something that I'll look at in a future video. Now let's further break down my holdings. You can see that 40% of my portfolio is made up of the Vanguard Lifestrategy 100% equity fund. For this product I pay an ongoing fee of 0.22%, and I currently have just over 5.1 units in the fund. If we have a look at the performance of the fund since I first invested, you can see that it was slowly increasing throughout 2019 and then through early 2020 as well. You can also see that throughout this time I was continually pound cost averaging, as this is the approach to investing that I see as best. You'll also notice following the dip and throughout the dip, I continued to invest as well, and this will really strengthen any growth that I will get in the future. If we take a look at the equity portion of my portfolio, you can see currently this makes up 60% of the overall value. Each fund then has its own weighting towards my portfolio, which you can see under the fund name. There are varying fees for each of these funds, and this is often due to the liquidity of the underlying securities that make up the fund. What I mean by this is the securities that make up the Emerging Market ETF are often slightly less liquid than those that make up the FTSE 100 or the S&P 500, and this is reflected in the fee. If we take a look at the Emerging Market Fund in a bit more detail, you can see that I only began to invest in this fund following the market fall. This is one of the reasons I've seen good growth in the fund, because I only started investing after it reached the bottom. Now, while I'm a passive investor and I don't actively try to beat the market, I saw that the market was low across a number of different indices, and therefore I decided to try and buy into a select few, both the emerging market and the FTSE Asia Pacific, because they were low and I saw growth opportunity there. Taking a look at the FTSE 100, there are a few things here that I want to talk about. Again, you can see that I've been investing in this FTSE 100 fund throughout the year as part of my pound cost averaging approach. However, unlike the Vanguard Lifestrategy 100, which had that slow and steady increase in value over time, you can see that the FTSE 100 ETF has been trading sideways, meaning there's not been too much growth throughout the year. So between May and about March, you can see it stayed at around the £32 level. While this isn't a problem as such, it means that I didn't see too much capital growth in the FTSE 100 throughout the year, which is why now, following this market fall, it's been hit particularly hard. This could suggest that the British market is slowing down slightly and there's not going to be as much growth over the next few years, or it could just be as a byproduct of all the Brexit uncertainty. On the flip side, however, the FTSE 100 ETF does pay a nice dividend of around 4% per year. So while I've not seen too much capital growth in that period between May and March, I have been given around £12 in dividends throughout the year. Again, following the fall, I've continually invested and you can see the market is slowly recovering here, which is good to see. If you move on to the FTSE Developed Asia Pacific ex Japan, you can see that again I only began to invest in this fund following the market fall. This is the reason why I've had such a good rate of return from this fund. Similarly to the FTSE 100, you can see that between June and March, the market was tracking fairly sideways again, meaning there was no sustained level of growth. If the markets hadn't fallen so much, I might not have invested within this product until a little bit later in my investing journey. However, there was such a good buying opportunity, having seen it fall over £6 per unit, I felt like it was a good time to buy in just a small amount of my portfolio. Finally, we've got the S&P 500, which is well renowned for having one of the longest bull markets in history. Warren Buffett, who some people consider to be the godfather of investing, is commonly quoted to say that if he had to give anyone financial advice or investing advice, he'd say to put your money in a broad S&P 500 index. And you can see the reason why. Throughout 2019, it increased from just around £42 per unit all the way up to a high of £50. So when you compare this ETF to the FTSE Asia ex Japan and the FTSE 100, you can see that this is tracking in an upwards trend as opposed to tracking sideways. This shows the strength of the American market and shows why I'm going to continue to invest in the S&P 500. Again, I've invested in this fund throughout the year and then following the market fall as well, and you can see there's been some quite strong recovery since mid-March. You can see that shown in the graph here. It's made steady increases throughout the year, which is partly due to my continual investment and also partly due to my dividend reinvestment strategy, along with a little bit of capital growth, up until around March, when obviously the market had a quite severe downturn. But since then, it's grown quite quickly out the other side. Again, you've seen in other videos that I've made quite a lot of investments over the last 2 months, around £1,000, because it's a really cheap buying opportunity. So that, combined with a market rally, has seen my portfolio grow back to break-even point. Throughout the year, I've invested £2,810, and that equates to around £235 a month. I'm really pleased with this, as this is about £120 more than I was hoping to do each month. This is down to some of the side hustles that I have, along with match betting, which I've already done a video on, so check that out. Match betting has enabled me to make about £420 on average each month, which is tax-free and it's risk-free. So if that sounds like something you'd like to do to get some extra money, check out the video, I'll pop a link up above. After looking back at the previous year of investing, I think it's now important to look forward and set myself some targets and goals for the next year. While I would love to set the goal of having a personal rate of return of 50% for the next year, it's not realistic and it's something that I can't control, so as a target it's fairly poor. After seeing how much I've been able to invest this year, a realistic target might be to get the value of my portfolio to around £5,500. Now, by setting a goal for the value of my portfolio, that means that I have to factor in the rate of return I'm going to get over the next year. So rather than saying I'm going to aim for a value of my account of around £5,500, I'm going to say I'd like to have invested a total of £5,500 to £6,000 by this time next year. I think this is more than realistic, as in the past year I've bought a house and started investing, So obviously it's been quite an expensive year. So now I really think it's a time to push on and really grow this account quickly. The second goal for my next year of investing is to make £30 of dividends over the next year. In my first year I've made £19.62, so I really think this is a realistic target that hopefully I'll be able to exceed. My third target is to continue to grow my trading 2-on-2 account of individual stocks and shares. I'd like to get this to a value of around £1,000 by the end of the year. I haven't shown you this account yet as I've only just started it, but I'll show you it in a future video. So there we have it, my Vanguard portfolio worth over £2,800 and my goals for the next year of my investing journey. I think it's really important to set short-term investing goals, as this way it makes it a lot easier to reach your long-term investing targets. One of the things that's made it so possible for me to invest as much as I have in this first year are some of the things that I do on the side to make extra money. One of those things being match betting. Now I've already popped the link within this video, but I'll pop it up above me just again so you can have a look at what match betting is, as it could be a really good way for you to make extra money to springboard your investments. If this does sound like something you might be interested in, I've got a link in the description which gives you 14 days of subscription to the service that I use for just £1. So you can really give it a go, and in that time you can probably make between £100 and £200. Hopefully my Vanguard portfolio will see lots of growth in the coming year, but like I've said, I'm fairly happy with where it's at the moment, all things considered. In my next video, we're going to take a quick look at my trading 2-on-2 account. As I've already said, it's a very small account at the moment, and it's something that I'm looking to grow over time. It's made up of individual stocks and shares, and the idea is that this will supplement my larger Vanguard portfolio. So if you're interested in trading 2-on-2 or have a trading 2-on-2 account yourself, check out my next video. And with that said, I'll see you in the next one.